Sit down with my friend Michael Garcia with IC Life. Michael, thanks for joining me, man. I appreciate you being here.
Yeah, thanks, Daniel. Thanks for having me.
Yeah,
Appreciate
it's
it.
cool. It's nice that we get a chance to talk to other professionals around the country. Michael reached out. We made some time on a call, and I said, "Hey, man, we should connect back up and see if we can shoot some videos for people that want to learn more about retirement." So, how long have you been helping people with retirement and insurance?
Yeah, so I'm in my sixth year now,
Okay,
so about half decade already, um, and it's been quite a journey. Definitely some learning curves and some bumps in the road and pivots yeah, really happy where I'm at today.
nice. I'm glad to hear that. Yeah, we shared a call earlier and got to go through our background. We have some similarities and kind of our upbringing in the industry and some things, that we got to learn along the way, which is always good. But what part of the country are you in for people who don't know?
Yep, I'm in Huntington Beach, California,
Very nice.
so nice weather.
Nice. And what's your focus in your practice? Like, what's the main thing you focus on helping people?
Yeah, our main thing is just helping people reach their goals, financial
Mhm.
efficiency. So we sell a lot of whole life annuities, even like long-term care term. We're big on those four products, especially. So
Okay.
those are our focus.
That's wonderful. You told me a story about an interesting case that you had this year. I was wondering if you wouldn't mind sharing that because I think there's some lessons in there that people definitely want to know and can learn from this case that you were working on.
Yeah. So I'm currently working on a case, and we're moving over to a large term policy. So kind of the way this case came about was the client has a large VUL.
Hmm.
Um, and for those of you that know, like there's different ways to fund the UL products, right? You can max fund them at a guideline level, or you can minimum fund them. And so the agent set it up with a minimal funding, right? So 2 years down the road, my client is in real estate agent, real estate investor, and so she thought there was going to be more money in the policy to pull out for different opportunities, right? And only to find out there is a $56,000 surrender charge in the policy. And so the money she thought was going to be liquid isn't, right? And so the other thing she didn't realize is that there was a risk. We looked at the illustration. It shows an 11% return year after year, as if the market never loses. And so um,
Holy
you
cow.
know, and the no lapse guarantee was 29,000, or sorry, 2,900 bucks a month.
Oh my
Uh,
God.
yeah, just to keep the policy alive.
This is a UL
It's a VUL, yeah.
and the sales illustration that you had showed that it was assumed rate of 11% every year
Yeah.
and it was minimum funded.
Yep.
Wow.
Yep.
So for
And
those of you watching who don't know, that is just that's just ludicrous. That's
yeah,
just insanity.
yeah,
That,
absolutely.
that should not be allowed.
Absolutely. So kind of
So,
back to
so, so take me through this. I just don't get it. Was it like just the worst kind of shady agent out there who just like pulled one over on somebody, or was it? I don't mean to laugh, but I mean
I
like,
mean,
or was it someone that didn't know, or how does that level of miscommunication happen with that large of a sale? Like, how much cash value are we talking about?
current cash value is 69,000. So
Okay,
to
so what
walk
was the first year's premium?
$36,000,
When was it issued?
a little over 2.5 years ago.
And so she just figured out that she's not able to access a lot of her cash value.
Hmm. Yeah.
So she's put three premiums in and she can only access 56 grand.
She can access 13 grand.
Oh my gosh.
Because the
Crazy.
56 is the charge, right?
Right.
So she's only $13,000 over the $56,000 charge.
Gosh, that's insane.
Yeah. And so, you know, with what we do is really aligning people with their money and their values, right? Their beliefs. And so I like to talk to people about what they know and what what they believe in. Warren Buffett talks about investing in what you know. And so for someone like her who is um, an expert in real estate,
Yeah.
both as an agent as an investor as well,
Hmm.
um, obviously that's her expertise. That's where she should be investing in. And so now she's not able to with this money because it's all tied up under a surrender charge. And so it really isn't aligned with what her goals are. And then she kind of approached that agent and, oh, well, that's in there for retirement. And she's like, that's not my retirement, though. My retirement is my properties,
Oh my
right?
God.
So it doesn't even fit her goals.
You
And
just
so
helped her
that's
pivot basically.
yeah, yeah. And
Damn.
so it also came about because when she found out that was the minimum that she has to pay just to keep the policy alive and keep it up from the risk of lapsing, um, the market's not the same either, right? So she
Right.
makes a lot of money still, but it's not the same money that maybe she was making 2 years ago, right? And so that changed, and now she doesn't have the flexibility to really move the premium as she needs. So
Yeah, I was talking
rough
to a
spot.
buddy on his channel this morning about the same thing. Like, think about all these people that have these projections of 11%, and then you have a year like this year where that's, potentially not going to happen, and it wrecks your whole illustration. So that's so sad and unfortunate that
Yeah,
happened.
yeah,
That's just a classic example of just, wrongdoing. Obviously, she was not aware of what she purchased, and that's just wrong. So
yeah.
it's good
And
that
I
you're
think,
able to come in and run in force illustrations and figure out what's really going on and help her to understand what she has. Because a lot of people get sold products and then yeah, it takes them a few years to even figure out what they have
yeah,
if
yeah.
if
No,
they're
it's
seeing it wrong.
like I said, I think the the agent was just not paying attention to what position she's actually in and what her expertise is and what she wants to do with this money. So,
Wow.
and obviously she was concerned with the coverage,
Hmm.
uh, because she does own two homes. She does have not just uh, you know, kid, a daughter rely on her, but parents as well, right? And
Right.
so there's other people rely on her. So the death benefit was a huge deal.
Hmm.
Uh, but the agent definitely overcommitted her by putting all the death benefit in this VUL versus maybe mixing in just a straight term policy. So we can max fund, the maybe the VUL or what we're doing is a whole life, right? But um, so she's going to have her money liquid and accessible so she can actually invest in real estate going forward. But yeah, we're transitioning her to a large term. So most of the coverage, 80% of the coverage is going to be on a large term because
Hmm.
it's super affordable. It's like $350 a month
Hmm.
uh, compared to $3,000 minimum VUL payment.
Right.
And now she can build her whole life um, where it is focused more on cash, right? Obviously, there's still $1 million death benefit on there.
Wow.
Um, but it's going to be very, very liquid, right? And it's going to grow very well for her, where she's going to have money immediately to use for opportunity. So
Do you agree with this statement that people shouldn't buy life insurance for just the growth of life insurance? Rather, they should buy life insurance for what it could be as a foundation to their other projects that they're good at investing in?
absolutely, absolutely. So Daniel, what I teach people, number one, I think if you're not if the death benefit doesn't mean anything to you, I don't know that life insurance is the right fit. First of all, right? Like I think it's still life insurance at the end of the day.
Yeah.
But when you're using it as a financial tool and asset to build your wealth, the problem I see in the industry is just like all these agents are telling people to throw money into your life insurance policy, and that's how you get wealthy. Well, no, it's not, right? So what we teach people is number one, invest in what you know, right? So if it's real estate, it's real estate. If you can make, you know, 5x, 10x your money in your business, like focus on your business, right?
Right.
But what we could do is we could build a foundation uh, where your money works for you in multiple facets, right? You get extra benefits should something happen to you. But your money's safe, it's protected, and it's growing. But that's like the foundation. It's a foundational piece. So what I use is I use a skyscraper example. And
Yeah.
so in the skyscraper, And this is how I explain too, like you're still going to go build your portfolio. So your skyscraper is your portfolio,
Mhm.
and you would never lay a foundation and then walk away and say, well, that's good enough. We don't need to build the rest of the skyscraper. Right. And so that's kind of like what these agents are doing. They're laying a foundation with life insurance, but then they're not telling people, like they're saying that's the whole skyscraper. And it's not, right? So you still want to go out and you want to build your portfolio on top of that.
Mhm.
Um, and so that's what I look at. It's like that's the foundation. But then the other component to the skyscraper is, if you're gonna, this is why we use whole life, by the way, not UL products, for this particular reason. I know there's, other reasons to use UL, but um, if you're going to build your skyscraper and you want to compromise on the structure or the foundation of that skyscraper, you want to do it at the rooftop.
Right.
Right? If something goes wrong, you're gonna have to shut the rooftop bar down for a couple of weeks, right? And fix
Yeah.
it. And then you can open back up, but you got your whole building still. If you
Yeah.
take if you compromise at the foundation, the whole building is going to come down,
Yeah.
right? And so
Well
that's
said.
the issue that we see with these agents that are using like IUL as that foundation. Like the be your own bank kind of foundation is you're introducing risk, right? And so you're introducing some variable components to that policy that you're not in control of. And so what we do is we teach people like, no, we want this to be a rock, a foundation. If you want to add a universal life for another reason, there are plenty of good reasons to do so. And I know you know very well, which is actually how we got connected, right? Because I was
Right.
like,
Yeah.
tell me about how you're using IUL in this manner.
Yep.
Because I wanted to learn from you. Um, but when it comes to this particular purpose, I always educate like, hey, let's go with whole life because we don't want any cracks in our foundation. We want it to be rock solid.
Yeah. Well said. That's awesome. Man, Michael, this is so great. I'm so glad we connected. And I think it's important for us to sit down and do this once in a while for us to talk, share ideas. And I think that's really helpful if we have this great network, which we do through Life 180 and everyone that's part of that we get a chance to visit with. So this is great, man. Thanks so much for coming on. I'm glad you took the time.
Yeah, no, appreciate it. Let's
That's
do it
awesome.
again.
Yeah, we will. Hey, if you enjoyed this video, I want to say thanks so much for watching. And if you want more information about different types of life insurance, check out this other video we did on the different frameworks. It might be helpful. And then you can come back and watch this video and maybe have some more context of these different kinds of life insurance Michael alluded to. So anyway, thanks again for watching. We'll see you in the next one.